All right. Good morning, everybody. Sorry for the delay here. Wanted to start promptly at the top of the hour. Had a few technical difficulties here, so I think we are good to go. So today is Thursday, December 18th, 2025. Welcome to this month's Capital Markets Update and Outlook call. We have a special presentation for you today as we will be delivering our 2026 Outlook. We are live on our website as well as all of our different social media pages. If you are with us live or if you are watching in the recording, thank you for taking some time out of your busy schedule to be here with us today. If you are joining us for the very first time, my name is Eric Hagan. I am a financial advisor and president of Capital Consulting Group, or CCG. CCG consists of myself, of our Chief Investment Officer Consultant, Tom Fox, who you will hear from in just a few minutes, financial advisors Dan Oshman, Rana Grant, and our client support team, Jeff Halverson, Karen Miller, and Josh Denny. Together, our goal is to help individual investors make their next financial decision, and the one after that, a good one. One of the ways that we deliver on that commitment is through today's monthly update. Today is an opportunity for each of you to look over our shoulder, get a balanced analysis of what we see, and ultimately to be a more informed investor. We do this in two ways. One, we can help you see your entire financial situation, both today as well as every year into the future, through our personal wealth planning services. After today's message, if you'd like to learn more, you can go to clearfinancialfuture.com, and I invite you to watch the short 2-minute video. Secondly, we help our clients get invested right. Being invested right is distinct to every account that we manage, and SmartMix is our personalized portfolio solution for doing just that. Whether you have $25,000 or $25 million, SmartMix is our process for helping you get and stay invested right. And you can learn more at smartmixportfolios.com. Today, again, we're going to hear from Tom Fox. Tom will review the positives in the markets and the economy, the headwinds, and give us his outlook for 2026. It's already here. Ultimately, again, this is your opportunity to kind of look over our shoulder, get an idea of what we're seeing in the markets and the economy and what we're watching for. So I encourage you, if you have any questions, put them in the chat box, email me directly. You can also text our office phone number now. So I will be monitoring my email and the text service, and I would be happy to bring those to Tom at the end of today's message. We, again, love your questions. So, and then lastly, for those of you that are watching in the recording, please don't hesitate if you have any questions as well. We would love to field those for you, circle back with you at our first opportunity. So do not hesitate to post any questions in the comments section. Tom spends all of his time more behind the scenes doing market research, due diligence, running different analyses, and really focusing his attention on the economy and the markets. Tom has almost 40 years experience building investment strategies. He has an impressive long resume, and as always, I'm very excited to have him here with us today. And lastly, one more time, at the end of today's message, we will have Q&A. So whether you're with us here today live, which I see a number of you, so thank you, or if you're watching in the recording, please post those questions, email me directly, text our office phone number. We would love to field those questions for you. So with that, I'm going to bring up our theme for 2026, or almost. Let's let Tom introduce the theme for 2026. So the last couple of years, we've had the same theme. We've had the times they are a-changing. So Tom, good morning. Welcome. Oh, we do not have your audio, my friend.
Good morning, Eric.
Much better. There we go.
Good morning, everybody.
Good to hear you. So the last couple of years, we had the same theme. I think we've got some anticipation for the 2026 theme.
Yeah, the drum roll, please.
Drum roll, please. I should have had that sound effect ready for you. So the theme for 2026 is
times have changed. Slight variation from our last year's theme, the times are a-changing. And I found another song of Bob Dylan, Things Have Changed. And they have changed because now we're seeing with the transformation of AI in businesses, in personal lives, it's already making a big impact. And it's going to make even a bigger impact over the next several years. So the times were changing, but now they've changed. And now the reality of the outcome of this revolutionary new technology is here among us. So things have changed, and we're going to see how that weaves into our 26 outlook. Now, the 26 outlook is very critical because it's very important because we're looking out into the future through 26, and we're trying to build portfolios around our outlook. Now, we can be subject to change. We can, if new information comes, we can always change it. But what we see today is going to guide our portfolio construction as we go into 26. And of course, as we always do in our updates, want to talk about all the worries out there, why we should be worried in 2026. And there are plenty of worries. And of course, we always say the market climbs a wall of worry. And everybody's talking about valuations. We've seen the pullback recently in AI stocks as the AI quote bubble was there, indicating that perhaps the AI stocks are overvalued. They may not produce what they're expected. And of course, we've had kind of a big pullback in that area. Why? Well, they were overvalued. They had high PE ratios. The overall market, because it's, let's say the S&P 500 has the bulk of its return coming from AI-oriented stocks. Of course, that market went down recently too. But that's a big reason that we should be wary about stocks today is the AI mega cap trades are at a high value. And we'll talk more about that as we move along. Of course, there's always policy and political risk is elevated, will be elevated. We got trade tax, regulatory shifts, unpredictable. And I think the big one is we're heading into midterms. And that typically is a politically very, and market-wise, can create all kinds of volatility as we head towards the midterms. And then we have higher for longer rates. The Fed has been indicating maybe they're on hold for a while until they see more data. Well, that could put pressure on our price to earnings ratios, forward price to earnings ratio. Stocks become vulnerable if the rates hold because there is some expectation that the rates are going to come down. But if they don't, that would put more pressure on the current valuation. And then we may have uneven participation with the AI productivity gains. Not all sectors are going to benefit, some more than others. So you can have winners and losers in the earnings participation of this great transformation we're experiencing today. And of course, execution risk. There's a lot of money going into AI data centers, but the payoff timelines are not there yet. We don't know. And this has been one of the vulnerabilities of the AI stocks. What's the payoff for all this investment that's going in? So there could be some execution risk in that. And then, of course, we always have geopolitical risk and AI monetization. Geopolitical and energy risk that could be there. A shock could disrupt supply chains, cause energy prices to rise quickly. That's one that's always hanging out there. And then we have index concentration risk. Returns remain, we've talked about this many times, dependent on a few stocks. Well, if something goes wrong with one or two of those stocks, it can bring down the whole index because they have a big capitalization weight in the index. Then we have liquidity-driven volatility. There's been a lot. There's hedge funds. You've got today's ETFs, algos, derivatives. that amplify downside moves. I'd add probably one more thing: private credit. Everybody and their brother are getting into private credit. Well, if, like the real estate debacle in the financial crisis we went through, if everybody and their brother goes into private credit, there's too many buyers, not enough supply. So people start buying weak items to put in their portfolio. That could be a big disaster. That's hanging out there. And then we have narrative crowding, popular themes, which, like for the AI theme, could pull forward and can end badly. We've seen a little precursor to that with the recent pullback in AI stocks. And another one is the Supreme Court overturns tariffs expected. And right now, the probability is that the Supreme Court will overturn Trump's powers to put on tariffs. We've looked at the outcome of that, and it's not as bad as what many are saying. So we don't think that's going to be a big deal. And there's other avenues he can go down to replenish that. So we'll see how that all shakes out. But right now, it looks like they will overturn it, or they'll have some modification to it or conditions to it. And then we have behavioral mistakes. Chasing winners becomes costly as valuations increase. We've already had 3 years of strong returns, 2 of them over 20. Maybe this one will end 20. It's about 16+% right now, year to date. But when you've had 3 really good years, well, what's going to happen the 4th year? We're going to be talking more about that as we move forward.
All right, let's get some of the positives on the screen, Tom.
There are positives, Eric. So why should we own stocks in 26? Well, here's a big reason, and this is the times have changed. Productivity is finally showing up. AI and automation are transforming into real margins and output gains. What have we seen? We've seen earnings beating estimates, over 80%, where the estimates were beat. Why? Because there's real margins and output gains that are occurring because of AI. And we're only at the beginning of this. And if we look at earnings expected to take the lead, everybody's talking about the valuation, the forward PE being 22 or 23 forward earnings PE ratio. But what happens if the market, the stocks, actually deliver double-digit earnings growth as forecasted? And what the markets are saying that 26 and 27, Eric, will be double-digit growth. And a lot of this has to do with AI. Well, when the E on the PE rises, then the PE will stay where it is or even go down slightly. So we have more upside in the stock market. And then where's our Fed today? They're accommodative. What are they talking about? They're not talking about raising rates, but they're talking about staying right now where they are or even lowering rates. Expected that rates will drop. And after today's inflation announcement that came in much cooler than expected, much better, there's now even a higher probability of more rate cuts coming in 26. I'm going to add another one that I didn't put in there, Eric, and that is the end of quantitative tightening. QE is tightening, or QT is ending. And what that is where the Fed have been selling treasuries into the market. Well, that hurts the bond market, but it can also hurt stocks. But now that's reversing this month. The Fed is going to start buying 45 to 50 billion, 40 to 45 billion of treasuries, which is a reversal. So that is a dovish statement that they've made, and that's the kind of the journey they're going to go down, which will be good for bonds and stocks. And then we have the CapEx super cycle. It's continuing. AI, power infrastructure, reshoring, multi-year growth. If we're going to look at a chart that looks out in the 26 and 27, and this CapEx is what corporations spend to grow their business, is growing dramatically and expected to grow, especially in the AI area. And then, of course, we have the one big, beautiful bill, the OBBB benefits. And that what's happening there? Well, we're going to have lower effective tax rates. We're going to have corporations will have accelerated depreciation, investment incentives to boost free cash flow and support higher equity valuations. This, I believe, will be bigger than what people expect. Very positive for corporations as we go into 26. And then, of course, there's so many companies with strong corporate balance sheets. The market leaders today, they're cash rich. They have huge amounts of cash flow, financial flexibility. Recently, we have seen them take on some debt to expand their AI investments, but we're not worried about that. Companies overall are in great shape as we move forward into 26. And then we have operating leverage expanding, stabilizing costs, amplify incremental revenue growth. What's happening is you have fixed costs for companies, and then you have variable costs. Well, if the variable percentage is higher than average, and then there's the fixed, you're still is lower, then you don't know what the future is. Well, as we enter 26, much of that variable is now moving to the fixed side, which means that every dollar coming in revenue will now go to the bottom line. So there's a lot of fixed costs increasing into 26, and that variable is going down as a percentage. That's all really good. Okay, then we have buybacks and dividends. They're growing. This is a big part of the driver for stocks, but we're seeing the buybacks and the dividends growth continue. More and more buybacks. Companies are buying back their stock. That's taking supply off the table, and supply demand economics 101. When you have less supply and a higher demand, that increases prices. And then we have dividends growing, which means that's a sign that the corporations are healthy, because we're seeing pretty good dividend growth as we move forward. Here's another one. History points to more upside. Stocks tend to do well, believe it or not, after 3 years of strong returns. And we're going to look at a chart on that. Many will think, oh, we've already had 3 years. We saw that in the why we should be worried. But if you look historically, actually, the fourth year looks very good, Eric. And then, of course, we have global capital favors U.S. assets. There's a lot of deals being done to bring money into the United States for manufacturing and other things from companies, as this administration has been really working overtime to bring capital into the United States, and money's coming in here, which will be all good for U.S. companies. So that's looking very good. And here's my last one, the risk of missing inflection points. You remember, Eric, in April, when the market went down 19% from its recent peak. And many hedge funds, registered investment advisors sold into that downturn and did not get back in. Their percentage of that was in equities didn't happen. And you remember in the mid-March, we went the opposite way and we bought into that bottom. And of course, that has paid off dramatically as we went to all-time highs. So there's a risk. And I believe that many managers got burnt in April of last year. They're not going to miss out in 26. So I think they're going to stay in, because if you miss the inflection points, you really miss it. In fact, in one day, Eric, in April, the market was up 9.1% in one day. Well, what if you were in? You miss almost 10% of the return that for the year. So anyway, we kind of went opposite as we started going in, as people became more fearful, and then that has now paid off for us.
Very well. Yes.
All right. Well, this recent pullback, I'm just going to talk about the rest of this year in this next slide. The recent pullback could be an opportunity. There's a lot of seasonality that points to that when you get a turbulent December, like we had in November, we had a definitely in the middle there, you can see that It was a very turbulent November. Then it rallied back hard. And we're also right now we're in a turbulent month this month. So what's going on in December? We think there's a possibility, it may have started today with the inflation number coming in better than expected, that we may have what we call a Santa Claus rally. Now, typically that happens, this seasonality happens after Christmas. And then it runs into the new year. So we think there's a high probability that we could end up getting a nice rally into the year end as we move forward in December.
Got a nice little rally going here today.
There's one happening today. All right, what's the case? Why are we bullish at 26? We're going to look at a number of graphs that I think point to it. This is 4 years into the rally. What happens in the fourth year? What's the average return? You can see it's kind of an orange bar. That's 4-year runs. But the average return in the fourth year, when you've had really good years coming into the first 3 years, is 12.8%. That's a high number. And so when some people say, well, we've already had 3 years, that was in our wall of worries. But we don't think it's a problem because history points that you can still have a great year even in the fourth year of a bull market. Here's another one. When the Fed starts cutting rates or restarts interest rate cuts like we have seen recently, the returns are very high. You can see it 18.2 over the next 12 months. We got an 18.2% on when Fed's cutting rates. If there's a recession, then it goes to 13. With no recession, it's 18. With cuts with recession, you can see that it could be a negative number, minus 2.7. We don't see a recession coming in 26, so we think we'll be at the higher end, and we'll see that at the end of our forecast as we go into 26. But typically, unless there's a recession, if Fed's cutting rates, the stock market does very well. Here's another one, the massive AI CapEx investment into AI. It's gaining momentum. There's no end to sight. Look at 26 compared to 25. We have an almost 400 billion. It's going to go to 520 billion, the estimate, and 600 billion in 27. This is not ending. This is Amazon, Microsoft, Google, Meta, Oracle, and doesn't include the smaller ones, but you can see there's no end today to the amount of money that's going into AI. Why? Because these tech leaders see what's coming with artificial intelligence. It's going to change everything, and it's changed. All right, here's another reason, revenues and earnings growth. 26 and 27, I have them circled, and you can see that that not only are margins expect to increase, and that's AI driven, and it could exceed that, but we're looking at double-digit earnings growth. If you compare that to 25, where it's a little over 12% growth, which surprised everybody, the 26 and 27 earnings growth is even expected to be higher than it was in 25. Earnings drive stock prices. This is all good. And you can even see the revenue growth will even be higher than it was in 25 and expected in 26, 27. And the big reason, that bottom graph, part of the graph, you can see that the margins, net margins are increasing. And what's driving that? Technology, artificial intelligence. And we think we're just at the beginning of that. So earnings or revenues, margins look very good. And it's another reason to own stocks in 26. And then, of course, we have Mag 7. Their growth and their contribution to growth is still going to remain a powerful driver. I circled 26 estimates. You can see that there's going to be more growth for the entire S&P 500 coming continually from the Mag 7. So these companies are not only investing, they're not only doing well, but we expect them to continue to do well because their growth is going to still dominate all the 493 companies outside of the Mag 7. So, but you can notice even the 493 outside the Mag 7 as compared to 25, that's expected to grow. So all of this is going to bring great opportunities in different kinds of stocks. We've showed this chart last month, but I wanted to bring it up again. This is the bull market now and over three years. And if you can see the red line, this is the strength and the duration of past bull markets. This is where we're at, the red line. You can see that there have been four times that the bull market ran much further than what we've run so far. That's another way. If you look back in history, what this tends to point to is that this bull market may not be anywhere near over. Now, if we look at on an annualized return, this is the average return for the past 12 bull markets. You can see we are now this updated. If I were to update this with this pullback, Eric, that number would be lower. So we see more upside annualized return per year than what we have now. And we think there's still upside, and you'll see it in our forecast for the S&P 500 next year. Okay, this is a big one. Our portfolios have been weighted towards AI and technology more than the market. And this is a variance in the S&P 500 returns since 2015, explained by a dominant underlying factor. And you look at growth or value or momentum. You can look at a number of factors, but you can see that there's something out there within all the indexes, all the portfolios, that what's driving returns, and it is the AI factor. AI is driving the variance in S&P 500 returns. So what does this mean? That if you over diversify away from AI, or maybe even an equal weight, you're going to underperform the market. And so we have been overweighting this area. We're going to continue to overweight. We'll give our AI outlook a little later in the presentation. But you can see if you didn't have a heavy weighting in the AI-oriented stocks, you didn't perform very well relative to the market. And here's an example. S&P 500 cap weighted year to date, it's around 16+%. If you look at the equal weight, it's 11%. So there's a 5% variance between the equal weight and the cap weight. And the cap weight, of course, is heavily weighted because of the top 10 stocks, AI-oriented technology stocks. So here's what we're saying. If you over diversify, you probably will underperform. And we think this will continue into 26. Here's an interesting chart. This since 1928, we're looking at times when we had 3 years of 20+ returns. Now we're just under 20% this year, but we think there's a possibility we could reach close to 20% by the end of December. But what this shows is what's the return pattern in the fourth year. And what do you see? I see lots of volatility, Eric. And it seems that this is the average returns composite of history when you've had in the fourth year of a bull market. But what you see is there's volatility, and it tends to run up at the end of the year, and there's a big rally. But you can see you lost all your gains you had in the middle of the year, and then it came back and then reached back up to where you were before. This could, they say that history rhymes, not exactly as, nothing repeats exactly, but it does rhyme. And we could see something similar to this in 26. And this is why we believe you have to be very patient. You'll see some of my forecasts regarding volatility in 26, but you can see that there could be some ups and downs next year. So get your seatbelts on, but we think it will come out really well at the end of the year. All right, weakness in jobs and a new Fed. Chairman Powell's going to be replaced, and I think it's going to be announced next week by the president. And of course, he's going to put somebody in there that's tilted and more dovish towards lower rates. That's sort of a Fed put. Here's another reason. Fed Chair Powell says that jobs numbers may be misstated by 60,000 jobs a month. So what's happening here is you could end up, what the Fed believes is that the labor market's even weaker than what's being reported. Well, one of their mandates is to keep the unemployment rate low and have stability in jobs. Well, that's a reason to lower rates. So there's an expectation that the rates will be lowered. We believe that's going to happen, and maybe even more than some expect. And of course, you got AI taking jobs away, not at a big margin, but it's increasing. So we think that jobs are going to get weaker as we go through the year. Here's a graph showing that revision. You can see the blue is the official estimate, and then after adjusting the Fed's for what they see, it's being overstated. Well, that's a big difference if you look at just the light orange bars. So what does that mean? It's a reason for the Fed to be dovish going forward and most likely to lower rates. And of course, if we look at the world scene, you can see the US has some of the highest interest rates around the world. And so we think there's room to lower, especially when you look at some of the other countries there. Some of them, there's 3 that have the same, but most of them have lower rates than we do. And we think that there is room for the US to lower their rates. So what happens if the job market slows? Well, there's 2 channels here. One is that they're going to lower interest rates. And when you lower interest rates, there's a wealth effect, which the Fed would like. And that is the stock market begins to rally. And the other part is their communication. If jobs continue to slow, they're going to start lowering rates. The stock market will rally like it is today. And of course, lower rates don't impact jobs immediately. So what that means, we can buy time. That the narrative, the communication that will come from the Fed if jobs continue to slow will be, they're going to do faster cuts or more cuts than expected. What does all that translate to? And this is what I call bad news, jobs slowing. Fed reaction is good news for stocks. And sometimes that inverts, Eric. Sometimes you get good news and it's bad news for stocks, or vice versa. So this can change, but we believe that if there's bad news in jobs, then the Fed's reaction to that, lower rates, communication, and so on, will cause stocks to go up. And of course, new Fed chair coming. We've talked about that. Most likely going to be more dovish. And here's a phrase that Wall Street says: bull markets don't die of old age. They're killed by the Fed. Well, there's no indication today that the Fed is going to kill this bull market. Consumer spending remains resilient. We expect that, especially in the upper income. Here's an interesting chart. It shows the K consumer reality, where the wealthiest are consuming more. This is consumption. And you can see that the wealthiest are consuming 40%, of wealthiest 20% are consuming 40% of total consumptions. And you can see where the trouble is in the left, the dark blue. That's where people are struggling in that maybe the last 2 on the left, but they're making up very small part of the consumption. And so far, the wealthiest are doing really well and their balance sheets are excellent. So we expect that to continue. So we don't see a big drop off. We do think the economy will slow, but it will not go into recession. We'll look at that later. All right, here's a possible new inflation worry. We got, if you look on the left, the last 10 years, CPI has been running very close to the electricity inflation. Last 5 years, that's changed, and the forecast is for electricity to rise faster than the CPI. Now, all those numbers may be adjusted down, especially, but with all the AI data centers coming in and the need for power and electricity, we think that's going to be a potential problem. Just like Eric, auto insurance. Inflation was off the chain. And so that was a part of the overall CPI. So what that did, it was raising the CPI, but now that's come down. And then you have used autos and so on. They've come down as well. But this could be another issue. We're going to watch it closely. But we think there's a lot of future potential in the electrification of the United States. And that is going to come through the corporations investing and building out infrastructure. And the thing that's positive is that the U.S. government is totally behind this. One reason is they want to stay competitive or outperform China, which is already electrified all of China more than the U.S. So this is going to be a heavy area of investing. We own companies in this area in our portfolio that we believe is going to be very profitable going forward in 26 and 27. All right, what's the future of AI? Well, we've talked about CapEx. You can see how much the start of the year and how they adjusted the CapEx. They missed it in 24, underestimated it in 25 dramatically. So the big question is, now they're in 26, they're going to miss it again. Why? Because CapEx AI is dramatically outpacing estimates, and we think it's going to continue to do that. We saw that in a chart, how much is expected. Now, this is how dominant AI is in the world scene. You can see what I've highlighted is what we have here is country GDP, and then stock indexes, market capitalization versus our tech companies. And you can see the top 10 on the far left, Eric. That top 10 companies market cap is bigger than all of China capitalization or their GDP. This is quite amazing. The top 5 is almost equal to the capitalization of China. So this is big. And what it shows in each company, just individual companies are bigger than countries, the index and the GDP, total GDP. So you can see how dominant these companies are in our tech sector, and there's good reasons: revenue growth, earnings growth, and we don't think that's going away. So here's our thesis for AI. AI is going to drive the cost of expertise towards zero. Why? Because you can almost get any question answered through ChatGPT or other platforms like that. So all kinds of information or expertise is available to anyone in seconds. And then you have the AI transformation we believe will be bigger than computing and the internet. This is not just a 1 year thing or a 2 year thing. This is going to be a decade thing, and it's going to change everything. They're even talking about that people in the future, Eric, will not need to be working. So they're talking about creating a universal revenue to people because they won't need to work because robots are going to work. The AI is working, and why humans will sit back and the leisure market's going to go through the roof. We'll see what happens on that. But that's what some are saying in the future. Many people won't have to work. We'll see if that pans out. I don't know about that. I could only stay so many days on a beach. So I like working, actually. So
Me too.
the impact, economic impact, sustained productivity gains across knowledge intensive industries. So we see productivity, operating margin expansion, AI adopters, platform owners, and then broad reallocation of labor and capital, creating clear winners and losers. So we're going to be watching that, but that is something that's going on. And then, of course, there is market risk. Labor market disruption may create volatility and policy friction because as AI becomes and robotics and so on keep growing, well, it's going to impact the labor market. And the labor market is going to have to be transformed to become more in the field of AI. So if you have kids coming up in college, they should be taking everything they can on tech AI as they go forward. Valuation excesses like we've seen, perceived AI leaders, we just saw about with that, with this quote, tech AI bubble. And then, of course, the rising risk of technological obsolescence for slow adopters. Some companies or even industries may be slow to adopting AI. That could be a risk for those companies and those industries that represent that. Bottom line, AI is not a cycle. It's a structural shift, a transformation. What we believe is the opportunities is substantial, but selectivity and risk control will determine long-term outlines. That's why we have to be watching this carefully, because, Eric, there will be winners and losers in the AI, and we want to be on the winning side.
Absolutely.
All right, here's our outlook, and then we'll go through each point. For 26, shifting towards a more favorable environment, even than 25, particularly for risk assets. Companies and economies are to benefit from AI-driven efficiency gains, the reemergence of pricing power, because we'll see stability in the tariff situation, positive operating leverage, we talked about that, and then friendly regulatory environment, the one big beautiful act, tax benefits, interest rate cuts by the Federal Reserve, and global disinflation and growth. And so we expect this is all to us pointing to a very good 26. So let's get down into the nitty-gritty summary of our outlook. This is what I want you to get your seatbelts on. Our number one point, extreme volatility next year. So we don't want to react emotionally. We expect ups and downs, high volatility both ways, like we're seeing today or back in April when the market went up 9.6% in one day. We could see that kind of volatility on both sides, especially in AI-oriented stocks, which we've seen recently. We don't expect that to go away. We expect it. So expect volatility more than we had even in 25. We believe the economy stays resilient, consumers keep spending, and there will be no recession. There could be a slowdown, but we don't expect it to go into a recession. Disinflation arrives. We're probably on the minority side here, but we think CPI retreats to Fed target 2%, and this will deliver price stability. Well, that's good for lowering rates. So we think that that CPI inflation is going to come down. And we also think the Fed will, as a result, will keep cutting rates. They'll keep cutting rates due to the labor weakness. And we think also because the inflation will be lower than expected. And what happens, the bond markets, which had a decent year this year, not quite what equities did, but we had finally a good year in bonds. So we think that will continue as prices rise and to respond to the lower rates. And we are bullish on stocks. We see pullbacks or any weakness because of that volatility we're talking about as a buying opportunity. Why? What's the catalyst? Policy support, economy, Fed, AI-driven productivity gains, and so on. And we do believe Many people are getting off the AI bandwagon for now. We're staying in. Eric, we believe they're going to take the lead again. High quality technology AI beneficiaries recover from recent pullback and continue to dominate. And then, of course, the stocks, what is our forecast next year? Stocks end the fourth year of a bull market positive. We do anticipate a correction intra-year, but at the end of the year, we're expecting a 10 to 15% return. Wild card, we've got wild card geopolitical events and so on, assassinations. You can read through that. Middle East escalation, U.S.-China trade, tech conflict, global shipping disruptions, election instability. We could see that with the midterms coming. Cyber attacks always out there. Commodity energy shock, that's out there. And then I put Russia, Ukraine, but I added or other. Because a lot of there's several of the countries on the border of Russia are preparing for war. And there was a recent article talking about the war machine that Russia's building is bigger than what they need for Ukraine. So there is some view that they're not stopping with Ukraine and they may go into other countries. Of course, this would be a big geopolitical event. But we put or other, and countries are even right now preparing for it that are on the border of Russia. So we'll see what happens there. Of course, they would enter NATO territory, and that could create all kinds of things. But those are wild cards out there. Nobody can forecast them or predict them. But we want to keep an eye on all that as potential. But that's our forecast for 26. So we're bullish. We think AI recovers and leads again. We think inflation comes in lower than expected. The economy stays resilient, no recession, and so on. So that's our view going into 26. And of course, it's subject to change if things change.
Things have changed, Tom.
They have changed.
Thank you very much, Tom. As always, we really appreciate your objective kind of weight of evidence of view and approach here. Going clearly through the challenges, the positives, and putting it together into an outlook. So thank you for that. Now, I would love to open it up to any questions. And so if you have a question, feel free to shoot me an email. I did get one here already. Or you can also text our office phone number, 952-540-0153. And I would love to bring any questions to Tom. It's always amazing, Tom. We do this every single month, and it's just amazing how much information there is to process about what's going on out there in the world, between the economy and the markets. And this next question, or this first question, has to do with a chart that you showed regarding the fourth year of a bull market. Let's see this one. So the question has to do with the kind of the timing of these pullbacks. So you're bullish, you see volatility. And the question has to do with going to cash and any tactical moves. So exactly the question is, Tom, will you be considering moving to cash in the fall of 2026, given this chart showing the possibility of a volatile dip before a recovering rise in the fourth quarter? So speak a little bit about the volatility and the timing of that volatility. And then thirdly on that, any potential moves to cash and how you might be thinking about that.
Well, that's a very good question. And this chart would make sense to do that. However, history doesn't exactly repeat itself. It rhymes. So we don't know exactly when that would take place. And you can see it's very short-lived. What I would say, we will not go to cash unless there's more evidence that emerges next year. That, in other words, if things don't quite look as bullish as we expect, we could possibly add some cash. But based on our forecast, we probably would not. We would just write it out. That's why I'm trying to encourage people to be patient at 26, because we will have bumps. But we believe it will recover more on the upside. And so this is an average of pattern. This is an average pattern. Will it go exactly like this? Nobody really knows. But what I would say is that any pullbacks, for example, you see some of the pullbacks, I would look at it as a buying opportunity. If people have cash or whatever, or they want to maybe even raise their risk profile if that's appropriate, I would not say we're going to necessarily go into cash, but I would look at it as potential buying opportunities.
Excellent. I think it's worth clarifying too that I think you stated you expect a correction in 2026, which by definition is a 10% pullback from a peak, but you are not today, at least, expecting a bear market. Would that be accurate?
That is correct. We're not expecting a bear market, 10%. We think and that's normal. Eric, the average pullback intra-year, if you look over long term, is around over 14%. So there tends to be a correction every year. And again, I would not try to catch those pullbacks. I would look to buy in or put cash to work or whatever, become even more bullish if we do get a pullback. Now, this is subject to change. If the evidence changes, we will definitely react differently than we are right now.
And to add to that, our baseline is we're not going to try to time corrections as it relates to tactical moves in or out of cash. That would be reserved for potential bear markets, which would be a 20% pullback. And so long as we're seeing corrections 2026 and not bear market, that would take a potential tactical move off the table. Again, that's today, but and things can change. But just a friendly reminder that that's kind of our view. Corrections are hard to time, and they can end quickly too.
I think that's well said, Eric. Because we're not looking for corrections. Corrections and pullbacks intra-year are normal. What we're looking for is that bear market, what's 20+% downturn. That's the one we would want to miss some of it. We don't see that in 26, but we're going to certainly keep our eyes upon it.
Excellent. Had another question come in. First of all, some praise, some appreciation for seeing some realism around AI. And the question though is how is it that cutting interest rates can happen and not fuel inflation?
Well, right now, the cutting interest rates could long term create pressure in inflation. In the short term, it will not. And so we think looking out only through 26, we think that there's going to be more on the cut side. Remember, it takes a long time. It's like a big ship coming into a pier. They have to put the brakes on way out, miles out even, because it takes time. So we don't think that it will have an immediate impact. It could down the road, but then by the time that's happening or could happen, then the rates may go back up. But right now, we're only looking at a dovish Fed. We got a dovish Fed chairman coming in. We have the inflation rate just came in lower than expected just today. So we're expecting that there's nothing out there that would cause inflation to go up. What caused inflation? Well, tariffs did. The pandemic, tariffs and things like that caused high inflation, but it was mainly the pandemic. In fact, the tariffs didn't cause anywhere near what many analysts had forecasted in inflation. And we think that with productivity gains, efficiency, companies can make things for less money because of automation and AI, that their prices are not going to go up because technology and the AI transformation is going to impact inflation in a good way.
Very good. Thank you. Just a reminder, if you have a question, now is a great time to post it. If you are watching in the recording, also encourage you to send us any questions that you have. Feel free to email me, text our office phone number, or there will be an ask a question button on the website here this afternoon. So the recording will be available this afternoon, where you're also able to ask a question here. And I'll also have a summary that you can download as well. So if you want the Cliff Note version of Tom's message here today, you'll be able to get that here. Should be in just a couple hours. Friendly reminder for those of you that don't join me, Monday mornings, I start my week off with a brief summary of what's going on in the economy and the markets. 9 a.m. Central Time, 3 to 5 minute brief economic update. Sometimes talk about some different nuggets, some things happening around the office, some things that we're watching out for. We're live on the website like we are today, as well as all the different social media pages. So Facebook, YouTube, LinkedIn, etc. So, and then 2 p.m. Central Time that afternoon, I send out an email with a summary and a link back to that video, along with some other things. So if you're not getting that email and would like it, please do head on over to the website and subscribe. With that, I'll take one last glance on any additional questions. I don't see any other questions at the moment, Tom. Maybe we'll get some after the recording is viewed by more, but any closing thoughts? Otherwise, I can go ahead and wrap us up here today.
Yeah, things have changed, Eric. AI is here, it's working, and it's only going to get better. I would encourage everyone to delve into AI, ChatGPT, or whichever one you like. And I use it every day today now, and it's becoming a regular part of my overall daily routine. So I encourage everybody to learn it, to understand it, to know as much as they can, even take courses on it. But I think overall, going into 26, again, our number one point at the beginning was extreme volatility. So we're going to watch that, but we're expecting it. We're not going to react to it. But we think unless other things change, fundamentals change, economy changes more than we expect, we will look at any volatility as opportunity. So that's, I think, the mindset of people should have is volatility in the 26 will be opportunity.
Excellent. Well, again, Tom, thank you so much for your thorough analysis of everything here today. We really do appreciate you. I will have our next monthly update on the calendar here and on the website here in the next few days. So that will be posted on the website. And with that, I will put our theme for 2026 up on the screen and sign us off. So from all of us here at CCG, we hope you have a wonderful holiday season, a Merry Christmas, a Happy New Year. Hope you get lots of great time with friends and family, and we will look for you all in the new year. So that concludes this month's monthly capital markets update and outlook call for December 2025. Bye, everybody.